And it's very, very clear that the AI trade still has momentum and it still has relative performance and it's still allowing for breakouts to be generated in stocks that really appear overextended by other metrics. And of course, probably are overstretched in terms of valuations based on history. So the market's just telling us that there's momentum behind the trade. We want to respect that. And it's our belief that there is the potential for that to continue in 2026, but not without some kind of pause. For some, a pullback might look imminent based on our measures. For others, I think it will be delayed. But collectively, there is enough of a loss of breadth, so market participation, and enough of a loss of leadership to suggest that we will get digestion.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As of the recording of this video, the S&P 500 index is trading at a new all-time high within less than 100 points of the big round 7,000 milestone. And Nvidia just became the first 5 trillion market cap company in history. So the bull market in stocks appears to be doing just fine, despite the skeptics' worries that current valuations are far too high when compared to fundamentals. So, will the party continue on from here into 2026? Or will the new year end the current 3-year streak of double-digit returns for stocks? To discuss, we're fortunate to welcome back to the program market technician and portfolio manager Katie Stockton, founder and managing partner of Fairlead Strategies. Katie, thanks so much for joining us today.
Of course, good to be with you again, Adam.
Thank you. And Katie, I want to note that we're recording this just minutes after the FOMC gave their latest guidance. They have just cut the interest rate as expected by 25 basis points. And they also did, as largely expected, they announced that the end of QT will be coming up here, I think, starting on December 1st. So a lot of dust still in the air. I appreciate you sitting down with us, but I'm sure you've got a lot that you and your firm need to go analyze. But anyways, we'll roll up our sleeves and dig into it. I did note this for you before we turned on the camera, but I want to note for the viewers, the very cool Fairlead Strategies print behind you. Very, very tasteful and very reminiscent of another print series that you and I know from a couple decades ago. And I love the aesthetic.
Thank you, Adam. Yeah, no, it's good. It reminds me of San Francisco too.
Yeah, yeah. If San Franciscans are watching, you probably remember the series of all the national parks and whatnot from San Francisco and the surrounding area that are in a similar aesthetic. All right. Well, look, let's just start with this. S&P 7,000. When do we get there? Today? End of this week? Next month? What do you think?
Things do happen quicker than we expect them to oftentimes with this market. And we had a summertime breakout. So when the S&P 500 cleared resistance back in June, we came to a measured move objective of about 68.80, and we assigned that objective for Q1 of next year, simply based on the trajectory of the uptrend. So this is all based on technical analysis, all price-based, trend, momentum. So those are our inputs. And, we felt like it was a pretty reasonable upside objective, but maybe not for October, but rather early 2026. But here we are, and these aren't resistance levels per se, but they do tend to see some consolidation. So I think it'd be natural to see the S&P 500 take pause here. But so far, we've just seen really not at all a meaningful loss of momentum. It's been remarkably strong, and these pullbacks that last just 2-3 days seem to give way to like instant buying pressure. We thought we saw the 20-day rollover a couple weeks ago, and then it just resumed higher. So this puts the market to us at a pivotal moment in a way, as it absorbs today's FOMC announcement, as it will absorb the earnings coming from the mega cap complex this week. So we want to see how we finish this week as a way to understand, is risk somewhat heightened as we come into November or not?
All right. So let me ask you this then. You said it should have shown remarkable momentum. And in the intro, I gave a nod to the doubters here who are just looking at the the multiples to earnings and saying, dear Lord, like these are some of the most stretched we've ever seen. Um, is the current market momentum warranted?
Well, that's a bigger question, frankly. And when I hear 5 trillion on anything, it's just astounding in terms of the numbers, right? But the charts are never going to answer that question. They won't tell you why something is happening or even if it's warranted, but they will tell you what is happening.
Right.
And it's very, very clear that the AI trade still has momentum and it still has relative performance and it's still allowing for breakouts to be generated in stocks that really appear overextended by other metrics, and of course probably are overstretched in terms of valuations based on history. So the market's just telling us that there is momentum behind the trade. We want to respect that. And it's our belief that there is the potential for that to continue in 2026, but not without some kind of pause. For some, a pullback might look imminent based on our measures. For others, I think it will be delayed. But collectively, there is enough of a loss of breath, so market participation, and enough of a loss of leadership to suggest that we will get digestion. We see also the Nasdaq 100 index, which is pretty tech heavy, so heavy in exposure not only to the mega caps with exposure, but also more broadly within the tech space. And it's this large cap technology segment of the market that has been such a persistent source of upside leadership. So as soon as that changes, that will be problematic naturally with the technology's big footprint in both the Nasdaq and the S&P 500. We noted that in our weekly report today that the Nasdaq 100 is about 19% above its 200-day moving average. That's not bearish, but it does show an overextended market in its appearance relative to history, right? So we had to go back to July of 24 to find a reading this high. And indeed, past readings that were kind of parabolic moves like we've seen have tended to give way to pullbacks and not insignificant ones at that. So we're not using that as a bearish input, but it does put us on guard for any meaningful loss of momentum.
Okay. All right. So, if I hear you right, this can continue for a bit. We can certainly blow through 7,000. But as we continue towards 2026, you expect sort of at a minimum cooling off, at least a pause that refreshes, if not maybe more, sure, a correction could happen in there right now, but it sounds like your technicals are not really blinking any warning signs about that right now.
Well, the momentum kind of faded earlier this month, as we all noticed, and did briefly impact some of our gauges, enough that we have some overbought downturns on the weekly charts. And those are, for us, as some of the best market timing devices. So we do have some indications. We just don't have it really for the major indices. And that's, of course, what most people care about, right? And we don't have it for some of the mega caps, some of the large cap tech names that have been driving the upside. So until we see it for these broader market proxies and these large caps that mean so much to market sentiment, we're going to kind of just ride the trend, right, until it tells us otherwise. But indeed, it's already become much harder to find good setups from a bottom-up perspective because of the loss of breath that we've had. And it's been with us really for a few weeks now. So it's been harder to find good charts, ones that are actionable and don't appear overextended by our metrics. And we have, as we've discussed before, the Demark indicators.
Yeah.
The Demark indicators are a great way to understand trend exhaustion. And, right now there's a lot of those signals to suggest that there's a trend exhaustion underway. But again, not until you see the downtick in the momentum gauges like a 20-day moving average, like a MACD indicator, will we really react to that.
Okay. And just to make sure I'm following, are you seeing the Demark indicators, starting to trigger their warning signs? Is that happening kind of in the smaller cap and the other non-tech parts of the market, and it's just you can almost imagine it just sort of getting closer and closer to the center core of big tech, but it's just not there yet.
It is there. We do actually have counter trend sell signals on the weekly charts of the major indices. We have them for sure from a bottom up perspective in technology, but none of them have been confirmed. And we feel that they're higher conviction when they are confirmed. And there are a couple ways that that can happen. It can just be simply a loss of momentum that we feel is significant, or there's a qualifier from the Demark people that actually designates that confirmation. So they're not confirmed signals, so they're still not high conviction. But on the weekly charts, they're the first signals on the sell side that we've had since the April low. So it's not like they've been really noisy and stopping us out all the time. That's happened a bit on the daily chart, but on the weekly chart, these signals definitely have us paying attention. We also have them on a lot of the monthly charts, including for the S&P 500. That may not have any, implications for a few months. That's often the case. These monthly signals are really long in duration. But again, they give you that visual indication that we really want to respect any loss of momentum that does occur that's meaningful. So we'll continue to watch our metrics like the 20 days, but as we see breakouts confirmed, like this one for the S&P above the 67-65 resistance that we've just seen, if that confirms on Friday, once we're through all of the mega cap earnings, well, we're going to have to believe in that, right? Because breakouts to us are among the most actionable takeaways from the chart. So when we see breakouts, breakdowns, it's a great way to understand how to be positioned, and whether we like it or not, or whether we believe it in or not, if we have a breakout, we will defer to that.
Okay. Yeah, and those breakouts are kind of like, if the market's got a lot of momentum, you don't want to step in front of that freight train, more or less, right?
Well, yeah, and the breakouts are, if they're confirmed, so if you see price clear level, like Nvidia just this week cleared final resistance, just a minor level. It was right around 196, but still a bullish development. If it can hold up here for a few days, that does confirm a breakout. And as much as it's difficult to add exposure into strong up moves, it is often the right thing to do when you have these breakouts as catalysts, because what the breakouts do, they remove the resistance from the chart, meaning that the sellers that were there, they're not there anymore for whatever reason, and it tends to be a positive development. So it's a tough thing to add exposure into strength, but indeed these breakouts do sometimes warrant it. We just would caution people to make sure to wait for that confirmation, and confirmation can mean different things for different people. We just like to see it hold up there for at least a few days in order to confirm.
Okay. And we'll get to sort of allocations and strategy in a bit, but I take it from you, and correct me if this interpretation is wrong, that right now, even though you're seeing some signs of emerging concern, you're not recommending a change of strategy yet because the momentum is still positive.
Well, right now, so we actually in the last 2 weeks did recommend to our clients to get partially hedged from a top-down perspective, and we're not telling them to remove any hedges yet. But if we do see all of these breakouts, that just really unfolded over the last couple of days, if they hold through the end of this week, we'll probably tell people to pare back those hedging strategies, just because we don't want to fight against a tape for too long. So we are somewhat sort of hedged, I'd say, in our bullishness. And when I say hedged, we're not hedging a full portfolio by any stretch. We're talking about, 10, 20%, something of that nature. But something that can be additive, of course, when we do get into that corrective phase that has any significance to it. We're not talking about the 3-4 day moves, but rather the more significant ones that end up showing up on the weekly and the monthly bar charts. So we're bracing ourselves in a way for that, and yet we just still, are watching the momentum gauges, and they really have not rolled meaningfully yet for the likes of the S&P, Nasdaq 100, Nvidia. So let's see if that changes.
Okay. All right. Well, I do want to note that today I noted that combined, Nvidia, Microsoft, and thoughtful money are now worth $9 trillion.
I like
Yeah.
that.
I,
Throw
I,
that in there.
yeah. So yeah, it's just amazing to me that these three companies can be worth that much money together.
Yeah, there you go.
Yeah. No, I'm stealing that line. I don't know who I stole it from, but it was a game back during the Michael Jordan days where Michael Jordan scored 69 points. And the guy said, I'll always remember this as the game that Michael Jordan and I combined scored 70 points together
I
because he
love
had made one free
it.
throw. Yeah.
That's priceless.
No, anyways, feel free to steal that line for Fairlead strategies if you
I
want
love
to.
it. I
But
will.
the point is really, two companies now worth $9 trillion, right? And we've got several other 3 and 4 trillion dollar companies in there, or maybe 3 trillion. I don't know where Apple is these days. But um, a stat I heard this morning was that I think 40% of the market cap of the S&P 500 is made up of 10 stocks, the top 10 stocks.
Mhm.
And I'm sure for the Nasdaq 100, it's probably a lot more of a percentage than that.
Yeah.
So we have this. I'll call it a hyper concentrated market. You don't need to necessarily agree with that. Um, but yeah, I mean, when you have a sector that makes up that much of the overall indices value, breaking out, yeah, like I said, you don't want to step in front of that freight train. It'll just steamroll you.
Yeah, that's
Now,
for
of
sure. Yeah,
course, I'm sorry, go ahead.
yeah, I was going to say you don't want to be short a bull market cycle just in general, right? But especially when you're talking about the leadership segment within that context, it can be really dangerous. And one of our rules of thumb is that it's just not a good idea to sell short anything that's at a new all-time high or
Hmm.
close to it. And it's saved us in some ways because when we do see the loss of momentum that's preliminary, it's really difficult to catch the pullback, right? In the same way that if you're looking at the VIX, it's hard to catch those volatility spikes
Right.
when you're talking about like a counter trend position. So we try to put more probabilities in our favor, especially on the short side, because for the most part, the market is in a bull cycle. So we know that, even when we have a weaker tape, that the bias over history is still higher. So we're kind of fighting that bias.
Hmm. What's the opposite of don't try to catch the falling knife, right? Like don't try to short a rising rocket or something like that.
Well, and it's a great point. I even actually use this phrase today with a client on the phone. We talked about a false breakout or like a whipsaw higher, something of that nature. We always talk about shakeouts on the downside. So the
Hmm.
the word shakeout stands for shaking out the weak holders of that security,
Right.
right? So it's almost like the reverse of that would be, it's the buyers that are kind of too late piling in, and then all of a sudden they just get burned, right? So the phenomenon happens on both sides of the market. And what tends to characterize those false breakouts would be non-confirmation, right? So that's our essential tool, is to wait for the breakout to be confirmed. But also, if you see gaps up later in a rally, like it's a strong rally and you get a gap up after a couple weeks, that tends to be exhaustive. They call them
Hmm.
exhaustion gaps. That can be a setback too. And if
Because
you
gaps
see,
gaps like to be filled, right?
yeah, they do. And especially if you see that security fall back into the gap really quickly, that tends to be another setback. So there's nuances, and there's even, and we don't use them ourselves, but if you were a technical analyst who's using candlestick charts, there's candlestick price patterns that are only 1 day in duration. And what they're usually identifying, these reversal patterns, would be basically a weak close relative to a high low range. So if you see
Hmm.
a big run up and then you see like a terrible close, that can be indicative of a change of hands too, in the same way that it is on the downside. I mean, go back to the April low and look at the price bars around there, and you'll see, I don't know what you would call it necessarily in the candlestick world, but these sort of hanging price bars that look like they are, exactly when demand shifted.
Yeah. Yeah. Where the day had a big range but ends up closing up way near the top, right? So you have that
That's
really
right.
long tail. Yeah.
That climactic behavior. You could argue that we have some climactic action right now with these headlines that you've been citing. So I would say that there's some exuberance out there. We see it in some of the investor polls. But it could be crazier. Honestly, we've seen it ourselves. If we're talking about San Francisco in the late 90s,
Hmm.
I saw it then, and it can get more exuberant, right? So, we are just going to wait for that momentum shift.
Okay. So let me ask a potentially uncomfortable question, and feel free to pass on it. But as I understand, you are a technician's technician, as you said. You're dealing with the market we have, not necessarily the market you think as it should be. Um, AI is just such a monster uh, trade right now, and it has pulled the market along for now many years, several years. And we're getting to these valuations that I got to think you and I would probably not have believed if we had been told this a year or two ago, right? Um, Back to my point about the skeptics' views of the valuations, right? Of how stretched they are from fundamentals. Um, I guess two questions for you, but they're really the same question. Is AI in a bubble? But the maybe more sensitive question is putting aside her technical hat for a moment, how much does Katie Stockton believe in these AI valuations today?
Yeah, so well, and that's completely a fair question, by the way, because it is so topical. And even in our one of our newsletters today, we have an idea generator on Substack. We talked about trying to find an idea outside of the AI trade as something that's interesting, and it's not that easy, frankly. so, so we're looking for momentum. But when you can find it, it's obviously compelling right when it's XAI, because you do feel like AI is so overdone in a way in terms of the follow through that we've seen. And
Yeah.
yet, the trends aren't all parabolic across the space. There's definitely some that look really overdone without question. When you have a really steep up move that's nearly uninterrupted, well, then you just better be careful, right? Because if you were to wait for the moving averages to roll over, you're probably already pretty deeply in the hole. So we would just make sure, if we're investing in that space, to have some kind of way to manage risk, right? Of a big retracement. It could just be a trailing stop loss, or using the Demark indicators, whatever it may be. But I don't think it's a bubble. It doesn't feel to me like it did feel before the March 2000 peak, and that was the dot-com bubble, of course, and that's when I feel like I would come into the office every day and stocks would be up 3, 4, 5% even in a day. And it happened for a long time. So while we are getting big gains, it doesn't seem quite as explosive, nor necessarily as parabolic from a top down perspective as it did back then for me. So that's just based on a feel. I'm
Mhm.
sure we could run some numbers on that and some analogs, but it just doesn't have that same feeling to me. Talk to me when momentum shifts. If
Mhm.
we have some kind of inverted V to talk about, then maybe I'll change my mind after that. But as it stands, it doesn't have that same technical characteristic, I feel like. In terms of valuations, honestly, I have no idea. I don't study the fundamentals of these companies. I see the use cases. I'm like really excited and intrigued by AI, and we're already using it here in house, not for writing yet, but more for back testing. So it's been a great tool for us. So I see the upside. But of course, in terms of monetizing that's another question, right? Are the companies doing a good job? There's so much more to it than just AI and its upside, right? It's how are the companies navigating it and actually generating revenues. So that's not my area of expertise, but I will say, my guess is the same thing that did ultimately happen with the dot com bubble was that there were survivors, right? There were very strong companies that survived that and came out the other end, and we're still talking about them today, right? Like Amazon. Whereas there are probably a lot of names that we've already forgotten as well. And I think that that's probably the case here too with the AI trade, in that there's a lot of names that will just not be around in a few years, if not less, right? So it's a matter of kind of separating out the quality players in the space. I think that's going to be increasingly important with the gains that we've seen.
Yeah. Well, I think the question that's on the mind of a lot of my viewers is, I mean, I'm sure you can have a debate, but I think most people probably say, yeah, AI there's real there, just the way there was there in the internet during the dot-com boom. But the dot-com era just went bananas and pulling tomorrow's value into today. And we needed a long period of time before, the market really realized that value, right? And, Nasdaq famously, took 15 years or so to get back to break even, right?
Yeah, he did.
So I
Big
think
round
that,
trip.
yeah, so I think the fear that people have right now is twofold. It's one, a lot of people think that that's going on right now. Is it to the dot-com extent or not? Nobody knows, right? But that there could be a pretty big, correction in AI when people realize, it's going to take a lot longer for companies to start really monetizing this to justify, their current market values. But secondly, tied to that is, unlike the dot-com bust, which was kind of largely contained to the Nasdaq and in those companies, there's just so much of the indices now that are made up by these companies, and there's so many ETFs out there that no matter what the ETF says, its main holdings are Mag 7 companies. And so it's a sense of just the collateral damage that a material correction in the AI space could wreak across, portfolios of almost every stripe. And I'm not trying to say that this is definitely going to happen, and I'm not trying to spook anybody, but I do see it as a really valid concern. And of course, the big question is, well, if it is going to happen, when? And nobody knows that. So I'm not going to ask you that because it's just not knowable. But how much of a concern do you have for that concern that a lot of my viewers have?
Yeah, I think I definitely share the concern, and we're already in a way kind of spooked by the action because we haven't seen a pullback of any magnitude since April, and that's a very long duration. So it certainly feels like there's a dynamic at work here, something that's more related to market structure than it is just simple, price momentum or market sentiment. So without question, there's some dynamics that we probably can't measure all that well, but we know that the ETFs out there, the passive ETFs especially, are exacerbating the momentum and behind the biggest players most obviously. And that can be problematic when it does pivot, of course, because when they pull, they have to pull all at once. They have to stay aligned with the price action. So that can be really detrimental to people's portfolios. So the way we, rather than being fearful and trying to predict exactly when that happens, because as you said, nobody knows, we are all about building a portfolio that can withstand it. And also, as we recommend in our research, at times being hedged to that exposure. So there are ways to navigate, a big corrective phase or even a bear cycle. Which, if it is a bubble and that's unfolding, then yes, we will have a bear cycle whenever that unfolds. We want to be ready. From I guess, portfolio management perspective to navigate that and not, lose half the value of our portfolios.
Mhm. So, okay, and I from my take here in the cheap seats at Fairlead, you kind of take a twofold approach. One is, okay, let's construct a portfolio that is risk managed, right? So that we can absorb any catastrophic failure in any one part of that portfolio. But then also your bread and butter is watching the market technicals. And so there's a sense of like, okay, we're going to kind of know as we're going into some sort of big correction or something like that. So we'll be able to start making real-time portfolio adjustments to minimize our vulnerability to it. Am I capturing that correctly?
Yeah, no, it's right. So we're almost like adaptive or reactive in how we are positioning. But we do that in a systematic fashion. So it's not us sitting here and saying like, it feels like momentum's shifting. It's actually measurable for us.
Yeah.
We're using technical indicators that are mathematically based, and they give very clear signals, especially when you combine them as we do in our models. So it's a systematic approach to risk management, but also to leverage the momentum and the relative performance in certain segments. So it can serve both of those roles at the same time. We often are differentiating between like core long-term holdings in portfolios. We have been saying, because we've had a long-term bullish bias in our work, we've been saying for a long time, just stay with your core long-term holdings, especially the ones that have not seen a meaningful loss of momentum. Look beyond any corrective action for those. Whereas for the more opportunistic and or higher beta positions, right, that are there to supplement those core long-term holdings, those are the ones that we're more inclined to address in our positioning, right, when we feel that there's a corrective phase. So we're pretty clear to keep that core as long as we feel that we're not in a bear cycle.
Hmm.
And even in a bear cycle, there's portfolios that are designed to manage through that, right? With either alternative asset classes or ways to navigate the over concentration that you highlighted in the major indices. So there's ways to get around it. Some of those ways may limit your upside if you have hedged equity products.
Sure.
But listen, if you're a long-term investor, we're more interested in, not the high-flying moves necessarily, but steady gains and limiting drawdowns. Because if you limit the drawdowns, not only are you digging yourself out of a less deep hole when you come out of things, but you're impacting your portfolio favorably over a long period by just, not letting that equity curve dip, dip, dip.
Right.
So we're big believers in long-term investing if you can.
Okay. All right. Well, look, given all this, where kind of are you right now on an allocation basis?
So we have one ETF that we manage. It's called the Fairlead Tactical Sector ETF, or TACK, TACK. It is long-term in focus. It is treated oftentimes as a hedged equity type of product by advisors. But its design is exactly to follow long-term trends and momentum on the sector level using an equal weight bias, but then also to use asset allocation to manage drawdowns and rotate into other areas of global markets that are doing better than equities, especially during those really big bear cycles. When we launched the ETF, it was in 22, which ended up being a pretty big bear cycle for the S&P 500. We spent most of that year in just one sector, which was energy. And it was really kind of the only sector that was substantially in the green for the year. So there are years like that, and we have the flexibility to leverage those. We've been mostly full in our equity sector exposure of late. We actually have only one slice of our pie, which we have equal weight positions, 8 of them at about 12.5%. So one of those 12.5% buckets that we have has been designated currently for short-term treasuries, long-term treasuries, and gold. And those things can serve as a buffer, right? If you see a
Yeah.
corrective phase, and then TAC will adapt if the long-term momentum deteriorates further behind more sectors, meaning that they get kicked out of the portfolio. But for now, it's pretty risk on. With that one sort of piece, there's probably the obvious sectors that aren't included, like energy would be for one now. So to contrast 2022, energy just hasn't been great. It's been trending sideways to lower when, of course, technology and others have been trending very much higher. So it's just rewarding those long-term trends. And through the equal weight positioning and through also that asset allocation, the TAC portfolio tends to be quite low beta, meaning that it's not, going to be exceptionally volatile on the upside or downside. And then also it's maintained a low correlation to both the S&P 500 and its proxy, which is the Russell 1000 equal weight index. So it's a pretty unique product in that sense, and it serves a very good role in a portfolio as one of those core long-term holdings that hopefully you just don't have to worry about. But then in a very strong tape like we have had, we have been telling advisors to supplement, right? You want to supplement with the AI trade, with things that have been working. So those higher beta positions until they stop working. And then you want to make sure you build some cash to put back to work when, the consolidation or corrective phase, seems to be mature. So we like to have a piece of a portfolio that is reserved for that more opportunistic positioning, but a good core long-term, portfolio like a TACK to serve as a foundation.
Okay, great. And just to make it practical for the viewers, um, if you basically want to have a portion of your portfolio managed the way that Katie manages at Fairlead Strategies, you can just go buy TACK, through your brokerage and just let it ride.
It's a good way to put it. Yeah.
Okay. Okay.
Yeah, it's easy to access, listed on the NYSE.
Great. Yeah. And now, obviously, higher net worth family office type clients can reach out to Fairlead Strategies for more customized management, correct?
Yes. So we do actually have a great research business. We do research and consulting for individuals all the way up to the biggest institutions. So anyone who's interested in technical analysis, by all means, should come our way, because we do have the ability to create model portfolios and things of that nature.
Okay. And that's going to your website?
Yep, fairleadstrategies.com.
Okay, great. And when I edit this, I'll put up the URL to Fairlead. I'll also put up the the ticker for TACK and stuff when you had mentioned it earlier.
Awesome. Yeah, thank you.
No. Thank you. Okay. All right. So you mentioned a couple of specific assets I'd love to get your quick thoughts on. Gold. You mentioned gold. Gold had one of these breakouts, as did silver. And it has corrected since then. I've read your recent research report, so I know your latest thoughts on this, but could you share them with the audience here?
Yeah, of course. So gold has been, of course, very topical lately because it had a parabolic up move of its own and now has retraced. And it's that kind of dramatic pullback that puts people on edge. But in reality, it's just come back to where it was a few weeks ago. So
Mhm.
it's not that dramatic on the chart when you zoom out on the monthlies for both silver, gold, and other precious metals. But we do think it will continue, and that's based on the overbought downturns that we have on the weekly bar chart. So it's more than just a daily bar chart issue; it's a weekly bar chart issue, and so we think it will stay with the market here in the near term. I wouldn't get too caught up in whether that means risk on or risk off, because gold has been in a world of its own. It's
Mhm.
been acting more risk on, of course, right? At times, even when you would expect it to be more risk off. So it's just forged higher. So the breakout that we saw last in gold, the target from that, in the same way that we had 68.80 for the S&P, the target from the breakout in gold had already been exceeded. So we're left without having an upside objective. But when we get the pullback generating an intermediate term oversold reading, that's when we get excited to add exposure to take advantage of the long-term uptrend again. So that's what we'll go from, calling the pullback mode into, okay, now we want to find our re-entry. And I don't think we're there yet, but probably based on our indicators, we would expect to see that opportunity present itself before year end.
Okay. All right. So in the near term, wouldn't surprise you to see gold show more weakness, but you're still more optimistic long term, and you're just kind of waiting for that entry point.
Yeah, and the stochastic oscillator that we use is one of the best ways to time those reentries. So even though a lot of people will be inclined to say, well, what level do you want to buy at? There is support, of course, just shy, in fact, of 3,500 for the price of gold. But rather than use that as sort of a buy limit order or something like that, we recommend people watch these indicators and watch for stabilization. So we don't want to just know where support is, because then if it's coming down there and it's a falling knife, we don't want to add exposure into that. But rather, once you've seen a little stabilization, and that will show support discovery, it shows buyers stepping in, and then it manifests itself in those indicators. So we recommend using the indicators as a way to understand if the support is meaningful.
Okay. All right. Now heading over to energy, which you said you guys had been big into during 2022. Um, oil and gas, the main fossil fuels, it's a boom bust industry, right? So you kind of know wherever it is on the boom bust cycle, it's going to go the other direction at some point, right? And so energy has been out of favor all year, as I think you mentioned. World still runs on oil. Oil demand goes up every year, right? That seems to show no signs of stopping. With all the excitement about AI, we've seen some sectors like uranium and nuclear stocks go bananas. But surprisingly, the fuel that's probably going to power most of these data centers over the next bunch of years before we have all these brand new reactors is going to be natural gas. But again, market hasn't really been that interested. So it seems to me, again, from the cheap seats, that at some point here, market's going to care, or the world's going to care about oil again. Market's going to care about oil again. How do you determine if you agree with that general thesis, which I think you probably do, but correct me if I'm wrong. How do you determine when it's time to buy these stocks while they're cheap?
Yeah, no, we look at crude oil first. So that's going to be, I think, the primary source of our views on the energy complex. And that goes for any kind of like leveraged ETF. We always start with the source. People like to trade Boyle as one, right? Which is an inverse natural gas
Natural
fund, right?
gas, yeah.
Yeah. So we watched that. But we also watch the underlying commodities. So natural gas, we'll watch crude oil. And not until we feel like we've got a real advance underway there would we think about building overweight exposure to the energy complex, right? Because you want that tailwind. They are positively correlated. So with crude oil prices, we'll watch very closely for signs of a long-term bottom. And the long-term oversold reading that we had in, I think it was March, April, was pretty meaningful on the monthly chart. So that, again, puts us on lookout for signs of a bottom. And we do have a counter trend buy signal. That's in contrast to the one that we have in the S&P 500 on the sell side. We do have one that's not confirmed yet, so it's still low conviction, but it's occurred at a higher level than those springtime lows for crude. So there are some early potential indications that a bottom is being established in that sort of 55 plus range for crude oil prices. And if we see momentum shift, more meaningfully to the upside, well, that would be something that would draw us to the energy complex. And we'd probably also see in that the relative strength would start to turn even before we see the rotation into the stocks themselves in absolute terms. So you look at the ratios of, say, a Chevron versus the S&P, you might see that ratio start to tick up. And that's often your best opportunity to add to stocks that you would consider to be kind of like turnaround plays, right? Or ones that are downtrending, so a little higher risk and counter trend. It's when their relative performance starts to move higher or improve meaningfully. That's when we get pretty interested in that. So we're starting to see that here and there within the complex, but I think it's a little bit early to be convinced that it's a lasting shift.
Okay. If somebody right now didn't have much exposure at all to energy, would your advice be get a core position and then keep your eye out for that material momentum shift and then start committing real capital?
So you can do that. It's not one of our recommendations presently because we don't have enough evidence that a turnaround's underway. We just have a downtrend still for the most part, as much as we have some signs of downside exhaustion. You can really see it in the ratio of like an XLE to the S&P 500. But you can always buy something that is counter trend as long as you have a stop loss in mind, right? I would just really adhere to those stop losses, because in a counter trend setup, your risk is heightened. So I would have some kind of mechanism to manage risk. And it could just be you take the recent low and you say, I don't want to see it close a couple weeks below that. That's my stop loss. Takes all the emotions out of it. You don't get married to a position that way. And I don't see any problem with that. But for the sector as a whole, I would probably wait myself. And if I see some stocks, maybe individually, that seem to be doing better in relative terms, that would probably be the first place I'd go as long as crude starts to move.
Okay. All right. Thanks. Two last questions for you. The last one is going to be, Is there anything else that's burning brightly on your radar that I just haven't thought to ask you about? But before we get there, bond yields. So, as we kick this conversation off, we know that the Fed just cut another 25 basis points. They've just ended QT. We have, after a stubborn, you know, almost 11 months, the 10-year has now finally dropped below 4%. We know the administration would like to see it a lot lower. Where do you think the trajectory of bond yields will be in 2026?
We actually think a breakdown is underway in yields because you can draw big triangle formation on the 10-year chart, and you can see that it's penetrated the lower boundary of that triangle in yield terms, and it's right around 4%. It's actually ticked up a bit, and I know that we're trading right on it right now. I just had to look again just because of the volatility, but it is being tested hard. We think it's a breakdown underway, and that breakdown will go from sort of a neutral yields bias to a downward yields bias with next support around 367 in our work. So we are respecting the sort of cyclical down move right now, and yields is likely to continue, but we're viewing it within a secular uptrend, because the longer term metrics, things like our monthly cloud model, do point higher, and those would suggest that we will see ultimately another big low established and higher yields from there. So we don't want to get two steps ahead, but we feel like the 4% level is in jeopardy of breaking just based on the downside momentum and the breach of that triangle boundary.
All right. And when you say higher yields eventually, are you talking like, at some point in 2026? Are you talking like, all right, we think over the next 10 years, yields are going to go higher, and that's what you mean by higher yields?
Well, it could certainly happen in 26. We don't know when it will happen, but so the secular uptrend would suggest that over the coming years, so it is a very long-term trend. Within that context, you can have a year or 2 years in the opposite direction, but it would tell us that, let's say 5 years, we should be higher than where we are now.
Yeah. Okay. So you're sort of in the Jim Grant camp of the 40-year bond bull market kind of ended around 2022, and we're in a new secular cycle.
Yeah. Yep.
Anything can
Agreed.
happen in any given year, but over the scope, it's going to be rising.
Yeah, I mean, if you go back, you can draw a multi-decade downtrend channel on yields that has been reversed.
Yeah.
And so that I think is pretty meaningful. It may not be meaningful over the next few months or even a year, but I do think it's meaningful longer term.
Okay, great. All right. And then to that final question, is there anything burning brightly on your radar, has your attention, that's worth talking about that I just haven't had the wherewithal to think to ask you yet?
There's a few things. We're watching financials and real estate pretty closely. Financials have had really pretty terrible relative performance of late, and banks, regional banks, have been the culprits there largely. So we're discouraged by the action in the banks from a technical perspective, but maybe some people could infer that there's more to it from a macro perspective there. And a client today said, well, gosh, take a look at REIT proxy today. And we've seen a really big pivot to the downside that may reflect sort of credit concerns, right? So I think that that's something, if you're more of a macro strategist or investor, that should be on your radar. To keep an eye on the credit markets, make sure that you feel like there's no big risk there. So those are things that are not technical, but certainly can land themselves and stock prices and relative performance. And then I'd finally just say the VIX, the volatility index, can be really helpful and informational. We're not very keen on the VIX products for hedging, although we're guilty at times of recommending them just from a very short-term duration. But when we look at the VIX itself, it's a great way to manage risk, and to do so also with an unbiased perspective. So we've been, since we saw the initial spike, we've been sort of in the mindset that we'll see an aftershock in the VIX. And for us, the support level that we're watching is defined by the cloud model that we use, and it puts support right around 16.4 for the VIX. So as much as we're watching the S&P, we're also watching the VIX.
Okay. All right. I'm just putting my notes here. 16, did you say 16.5 was sort of the support?
16.4. Yeah.
4. Okay, yeah. All right. All right. Well, as usual, Katie, this has just been completely enjoyable and, as I like to say, financially nutritious discussion. Thank you for being so
Good way to
generous.
put it. Of course,
Yeah.
I'm happy to, and it's probably a good time to be having the conversation, even if it's not the most decisive time. It's like there's just a lot going on, right?
Yeah. Well, what I'd love to do is have you back on in Q1 and just kind of give us an update on all these things. Hopefully, we'll have the dust will have settled on some of these things. You'll have a little bit of a clearer view of what 2026 might look like. And of course, folks, in the interim, if you would like to actually, take advantage of Katie's work, either go seek out her research there at fairleadstrategies.com, or just ride her coattails and buy the TACK ETF and benefit from that. All right. Well, look, folks, please join me in thanking Katie for being so generous with her time, her insights, and the specifics of how she's allocated. And please do that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help above and beyond the resources that Katie offers there, maybe talking with one of the financial advisors that Thoughtful Money endorses, the firms you see with me on this channel week in and week out, about some of the trends, opportunities, and risks that Katie talked about, and to find out which ones might be relevant given your own personal situation. Feel free to talk to one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. Katie, I'd love to give you the last word here. We just had our fall online conference, which was fantastic, and I would love to have you in one of our conferences next year if you have the interest and the availability. But most of the people who are watching, we definitely have some professional investors that participate, but most are just regular people, that have worked hard or continuing to work hard to build wealth, to provide for their families. They want to prudently grow their wealth, but probably more importantly, they don't want to get blindsided, by one of these risks that you and I have talked about. What would your parting bits of advice be to them?
Yeah, I mean, just don't get married to a position and try to take the emotions out of it, which of course the
Mhm.
charts let you do in a way. Like, always, have a level in mind at which things will change for you, and to maybe keep yourself honest, write it down when you take that position. And you can't really argue against the prices. Price really matters. So you don't have to be a sophisticated technical analyst to see when something is breaking a support level. And I just encourage folks to use the charts to their benefit.
All right. Well, very well said. Katie, can't thank you enough. Thank you so much for
Of
coming
course.
on.
Good to be with you.
All right. And everybody else, thanks so much for watching.